I sent out the email about the symposium. I had one person say she wanted to go. If anyone else is interested, let me know. I need to get with the new head of department, make sure they've got the funds for the travel, that they should cover all the travel. So, all right. If you're an actuary, it's not a bad place to go to hear about an industry you might be working in. Okay, so tonight we want to use class time very, very, very well, right? No one's sitting there with nothing in front of them. What I'd recommend if you're on a laptop, I would get into Word and I would copy these titles into Word. And as we go through the rubric, take detailed notes so you can essentially be writing a paper tonight while you're in class. You're not wasting time. If you're taking handwritten notes, slow me down. You'll see some quotes. You might just have to put the first few words of the quotes with the ... if you're writing, or you can copy and paste. Have the article open if you're on your computer so you can find some places to copy. This is foundational to life insurance, understanding human capital. And so we want to make sure tonight when you leave, you're very comfortable. In fact, if I were you, I'd write most of the first part of the paper this weekend and get it out of the way, and even come meet with me if you have questions. I'll talk about the places of the paper where most people in the past have had really serious problems explaining what's going on in the paper. But we'll go through each one of these, and I might reference back the class notes. The class notes do have some pretty good quotes in there as well. But let's start off with, is everybody ready to go? You got everything copied? You need more time to get it set up? So have the rubric out. If you don't have the rubric, maybe take a picture of that so you have it on your phone or something so you can see the rubric as we go through it. So we're going to start off just with what is it that the people writing this paper are trying to accomplish. Anytime you take an article, you shouldn't just read the article. You should really spend some time up front. What are they trying to convince me of? An article usually wants to change your opinion on something, maybe teach you something new that you haven't seen before, but they have a goal. So we look at the author's goal. I'll somewhat start from new here. So the authors say there's two very, very important decisions. Anybody know those two decisions? What's one of the decisions you got to make as a financial planner? Okay, so we call it asset allocation. That does have to do with risk. In what way does risk come? The simplest way, and this oversimplifies it. If you taking some of y'all have taken my investment class, this oversimplifies it. Really to say is the percentage to stocks versus bonds. So you mentioned risk. I didn't see who said that, but you mentioned risk. So what would be high risk? A high allocation to stocks or a low allocation to stocks? So high would be more risky. So high allocation to stocks. If you're a conservative investor, you'd probably put most of your money in the bonds. If you're risky, like I recommend for people your age, is probably go 100% stocks. This is where I disagree with the financial planners. Those financial planners, yeah, so you get my bias. In my investment class, you heard this as well, but they'll say, hey, someone in their 20s, you should be 90% stocks, 10% bonds. I think that's that's just idiotic. Why do they say that? Well, for risk. Well, there's a few problems with that. First of all, if you have 90% of your money, so let's say you have $100,000, you put 90,000 in stocks and 10,000 in bonds. You may have 90% of your money in stocks, but you don't have 90% of your risk in stocks. You probably have 97% of your risk in stocks. Because why? Because stocks are so volatile. You're not going to notice the bonds really helping you that much. I can assure you in 2008, I never heard anyone say, boy, I'm sure glad I had 10% in bonds. I lost 34%, but I could have lost 36%. I didn't hear anybody say. What did they say? I lost a lot of money. And do you really notice you lost 34 instead of 36? Anybody? You don't notice it. Now, as a young person, you put 90% in stocks and 10% in bonds, and stocks are up 40% and bonds are up 5%. You'll notice that. You'll notice the loss return you'll get over time, but you're not going to notice the risk reduction. So for me, for young people, just stick all your money in stocks. We'll talk about that, how it deals with human capital as well, because we're going to say human capital looks more like a bond. You already got a lot of your money in bonds. That's what your human capital is. But even from a risk standpoint, but that's the argument. Low risk people are going to allocate more to bonds. Higher risk investors are going to allocate more to stocks. What was the second decision you got to make? Y'all read the article, right? What was the second thing? What class is this? The amount, they say demand, but I'm going to say the amount of life insurance to buy. How much life insurance should you have? Okay. And that's not the purpose of this article. So we haven't gotten there yet. What the article says is human capital is part of that decision. Human capital is part of that decision, but independently. So the article says, hey, financial planners, they use human capital and they're helping you decide your stock and bond allocation. They use human capital to understand how much you should have in life insurance, but they don't combine those into a unified model. Anybody remember where I disagree with them? I mean, I absolutely agree. Financial planners use human capital to decide on life insurance. Where did I disagree? Yeah, I don't think they use human capital for asset allocation. I've never heard one. So the article says they use human capital. If you want in your paper, you can say professor questions if this really is an input to asset allocation. We'll talk about it. I seriously doubt you're going to find a planner and say, what's your occupation? Oh, you're a nurse practitioner. Okay, your stock allocation should be 70%. Oh, you're a stockbroker, your asset allocation, the stock should be 40%. I don't think that conversation happens. But that's what this article is saying. We're still not to the goal. So what's the goal of this? Is a unified framework where human capital ties the two decisions together. So read the abstract again, get really, really clear. So when you write it in your paper, it's really, really clear. Their goal is human capital is important to asset allocation. Human capital is important to life insurance, but we need to combine it into one unified framework so we make the decision in a more intelligent, kind of organized way. All right. So the purpose of the paper is not to tell you your asset allocation. It's not to tell you how much life insurance. It's to tell you how you combine human capital, how you use human capital to combine those two decisions in one optimal decision. You might say optimal combined decision. So go back and read, let's go back and read the abstract. I already had it open. Financial planners and advisors increasingly recognize that human capital must be taken into account when building optimal portfolios. I don't believe that, but I guess how do they say increasingly? So I guess maybe last year there were 2 of them and now there's 3 of them out of 1 million people, maybe. So it's increasing, but I don't think it's very many. But human capital is not simply another pre-endowed asset class. I don't think financial planners really think of human capital as an asset class. So I really question that. It contains a unique mortality risk in the form of loss of future income and wages. Life insurance hedges. This is real important. We'll talk about the mortality side of this. You want to make sure in your paper you talk about life insurance being a hedge to human capital. Correlation is essentially -1. If a person dies, their human capital goes to zero, but they bought life insurance to offset the human capital, so that exactly offsets it. So it's a perfect one-to-one hedge. So human capital affects both of these, but these decisions were made separately. So you see the goal. See how clear I want you to be? Don't be ambiguous. Oh, this article is about asset allocation, but not really. This article is about life insurance. Well, not really. Well, it's about human capital. Well, not really. What is it about? This article develops a unified framework. What's the big input? The framework's input is human capital that enables you to make decisions jointly. You now see how that last sentence is really the goal of the article. Okay, so those other things, he says those are already in place. We don't need to write an article about that. Even though I disagree that they're using human capital for asset allocation, they're saying those are already in place. What we need to do is get those two decisions coordinated and let human capital be the piece that coordinates them. Some questions on that? And we haven't gotten past the abstract, and you already got a pretty good answer right there at the beginning. Everybody got rubric number 1 down? All right. So where's the objective function? The easiest part of the paper is put the formula into your paper. I usually give full credit if you just stick it into your paper. So where is the formula? Whoops. It's the formula and it's the key. I don't really even look that much for a discussion, but if you want to put a discussion here, you're trying to, well, what does the E stand for? You remember from last class? The expected value. And what are you trying to do with the expected value? Maximize it. What are you trying to maximize? This you alive and you dead. What does U stand for? Utility or happiness. So we're trying to maximize a person's fulfillment, contentment with life or death. Either way, I mean, you got the bases covered, right? Is there a third option? I remember at USAA, there was a life actuary and he talked about the dead state and the life state. And he said it in a way like there was a third option. I was like, what's the third one? I don't know. It's like, is there another option out there? So you want to maximize that. This you isn't you. We're not saying maximize the you alive state and you dead. Your happiness, your fulfillment in the alive state. But if you don't live as long as you like, you're at least maximizing what happens if you were to die. So that's what we're doing. And you got the pieces. I don't know if you remember the pieces. The D is how much you want to leave to your heirs. If you leave it to your heirs, you can't enjoy it. So 1 minus D and D. Anybody remember the QX without looking it up? It's your probability of what? Well, 1 minus QX, your probability of living. QX, your probability of dying. W, your wealth. Yeah, how much money you have. The H, human capital. On your dead side, you don't have the H. What do you have instead? Life insurance. So you have your wealth plus your human capital, or in your dead state, you have your wealth plus your life insurance. And that's what you're going to leave to your heirs. What if your wealth is massive? How much life insurance do you need? Not very much, right? Because they're going to get plenty. All right, so we're trying to maximize the expected happiness of your alive or dead state. And human capital is going to tie these two together. Why? Human capital is going to influence how you allocate the wealth. And human capital needs to be replaced by life insurance. So it's going to determine the amount of, always be clear on that. Human capital determines the amount of life insurance you need. You notice human capital is not in the dead state, but it is indirectly because it tells you how much that life insurance needs to be. All right. You're comfortable with this formula. It looks a lot easier, right? Once you kind of break it down. We look at it the first time, it's like, wow, that looks like a lot of stuff, but it's really not that massive. So how much life insurance you need, and then you're maximizing using how much life insurance you need and your allocation to the risky asset versus the non-risky asset. Those are the decisions you're making. That's the easiest part of the entire rubric. Now the hard part. Oh, I want the whole class to get this. I don't know if you will. I've never had a class do extremely well on this. So the next part of the article is going to do what? Well, we just said human capital is the key. We better have a great definition of human capital. And that's what these next three things are. Human capital. There's three things we're going to talk about with human capital. It's magnitude, its volatility, and its correlation. And those three things are connected. I obviously am a horrible professor this part of the class because about half the class doesn't get this at all. Let's see here. This class is smarter than my previous classes, probably so. Or maybe I'll just teach it better. If y'all do better than the previous classes, I'll assume it's because I did better. I won't give y'all any credit. So let's talk about this human capital. A basic definition. I think we talked last class. What's the easiest way you can define human capital? Perfect. Present value of future earnings. If you want to get real fancy, you could say expected future earnings. Present value of expected future earnings, because you don't know that precisely. It's an estimate. So there's three things we're interested in here. It's magnitude, its volatility, and its correlation. And these two are really subcategories of magnitude. I think some students really miss that. Volatility and correlation are going to impact magnitude. How were they impacted? If human capital is the present value, how did you take present value in your finance courses? What did you need in the denominator? A discount rate, right? Present value implies a discount rate that reflects what? Well, how did you decide your discount rate? You did the risk-free rate plus what? Plus a risk premium, you remember that? So the discount rate better reflect what? Risk. Does human capital have risk? You're a Supreme Court justice, maybe not much. As long as you don't get fired. I guess if you're a Fed governor, it's kind of risky, but it's pretty safe. If you sell suits at Men's Warehouse for commission, how confident are you there? You weren't wearing suits anymore. I don't know what they're selling at Men's Warehouse now, probably not suits anymore, but sales commissions on people buying clothes for work, and then you have a recession. So that discount rate's pretty important. You can forecast your future earnings, but you have to discount it. What determines the discount rate? So let's talk about magnitude. So this includes your education, training, your age, many more years of work. And we'll talk about in the second option, the second article, your optionality. So magnitude, the more education you have, the higher your expected future earnings. The more training you have, the more knowledge you have, the more years you have to work. Your chosen career, those are kind of things that are important. Your optionality, we'll talk more about optionality in Article 2. But these are the numerator. That's the numerator, right? That's your cash flow, how much you expect in the future. Where does the denominator come from? Denominator, the discount rate. It's going to be influenced by the volatility and correlation. All right, I'm hoping you're getting all this together. So you gotta, you got to forecast your future earnings, but then you got to discount it and you got to find a discount rate. That discount rate is going to be influenced by how volatile your earnings are and how correlated they are to the economy. And I would make that explicit. We're talking about correlation. You can say to the economy or to stocks because we're talking about asset allocation, right? Remember, we're talking about human capital as an asset on your balance sheet, and you're also going to be adding stocks and bonds to your portfolio. So you really are, I mean, ultimately, stocks and bonds and human capital related to the economy, but we're really probably more than anything else, we're interested in how your human capital relates to the stock market. All right, so more education, more training, younger age, more optionality. Optionality actually fits under the denominator as well. We'll talk about that. Probably fits better under the denominator, but we'll get into that. But those are the things that influence how much you think you're going to make in the future. Your chosen career is pretty important as well. There are other things in here. How much you're paying for college is a big one as well. I hear people have $200,000 in debt, which makes no sense to me in college. I don't know of an education in the US that's worth 200,000 bucks. UT Austin charges 100,000 for its graduate program, and it's not worth 100,000 bucks. I can assure you, 100% of what you can get at UT's graduate school, you can get online for free just without the networking. So you're essentially paying 100,000 bucks. So people are spending a lot. So you do have to adjust these somewhat, how much you're paying to get that education. But more educated people will make more money, definitely. But let's talk about the volatility. If you go to the notes, you'll see what I said on magnitude. Well, my notes are a little bit all over the place. The magnitude of human capital, its volatility and its correlation with other assets significantly affects these two decisions. So the magnitude is pretty important. The article talks about, I think I have it in here, but I just kind of overcopied from the notes, but find some things to say about the numerator. You may have other things you can think of there, but your future income, besides education and training, I think the article mentions a few other things, but what impacts the numerator? But let's talk about the denominator. So some jobs are much more at risk of your income being really high one year and really low the next year. You're on sales commissions. If you're likely to get fired at certain times or be laid off for some time, that can cause quite a bit of volatility. So higher volatility equals higher discount rate, and thus what does it do to the magnitude of human capital? Higher discount rate does what to human capital? Higher, does it make it higher or lower? Yeah, lower human capital. All right, so here's the part a lot of students miss because it doesn't seem very intuitive. If you have a really volatile job and you're not really sure, you may have some years where you're laid off and you have no income. So you have a really high risk. It reduces the magnitude of your human capital, and you're buying life insurance in an amount to offset human capital. What does it imply that people with really volatile jobs need for life insurance? So they need more than the average person or less? They need less. Why? Because their human capital is a smaller number. That doesn't seem intuitive. That's what this article is saying. People who have really volatile earnings need less life insurance. Why? Because their discount rate is higher, their human capital is lower. Do people really think like that? That's what they're proposing in this paper. So what do you do in your paper if you disagree with it? You write what the paper said. The authors are saying this. You can add a sentence that helps you on the critical thinking. I really question if this makes sense. A lot of people say, wow, you got a really volatile income. You better buy some life insurance. Some people think almost the opposite way. But they're saying, no, human capital is a present value. It is It has a discount rate. The other part of this is what it implies for asset allocation. If you have a really volatile income, what should your stock allocation be? Should you have a high stock allocation or low stock allocation? Low. That's the other part people don't understand. Oops. Oops. I don't know what I just did. Oh, sorry. Bill Gates put me off in no man's land. Lower need for life insurance, lower allocation to stocks. What do you think people with volatile income do with the stock market? What do you think stockbrokers do in your allocation to stocks? You think they're below average or above average? Probably above, probably the exact opposite of what this article is saying. So the intuition may not be there, but it does make some sense, right? If the stock market's crashing and that's when a stockbroker is going to lose their job, they probably don't want to have a big part of their portfolio in the stock market because they're going to lose their portfolio and they're going to lose their job in the same year. All right, let's try the same thing with correlation. Take this asset allocation out. So if human capital is highly correlated to the economy and stock market, you agree the stock market's very dependent on the US economy. So those two are very highly correlated. What does that do for your discount rate? Higher discount rate. It's just like the remember capital asset pricing model. There's high beta stocks and low beta stocks. High beta stocks are very cyclical. They're very tied to the economy. They have a high beta, which means we give them a higher discount rate, which means we give them a lower valuation. Just like what you learn in capital asset pricing model. When someone's human capital is very dependent on the economy, when the economy goes in recession, they're much more likely to lose their job than when the economy is doing strong. They have a high correlation. That gives you a higher discount rate, thus lower human capital. So lower need for life insurance and lower allocation stocks. It's a big part of the article, and it really explains the case studies. Get into it as they talk through the case studies. It really helps understand the case studies better. Questions on that? That really is the most difficult part of the paper for most students. So the Men's Warehouse sales commission agent, how much life insurance is he going to buy? Above average, below average? So how volatile is his income? Very high. What's his discount rate? Very high. So what's his human capital? Maybe lower. So much life insurance? Less, because human capital is offset by life insurance. And what should he do in the stock market? Probably be more conservative. Right? His human capital looks more like a stock than like a bond. So, and you can try this, go to Men's Warehouse tomorrow and say, hey, how much life insurance you have and what's your asset allocation? Oh man, you have way too much life insurance and way too much in the stock market. He may not buy that argument, but that's what the article is saying, okay? You can also argue not only is his income volatile, but it's also highly correlated to the economy. Commission sales agent selling something that people tend to buy more of when they have a job than when they don't can be highly correlated. So that's a person who probably doesn't use much life insurance and probably should be more conservative on their asset allocation. All right, any questions there? We'll see if y'all do better. I'm sure there's some like, man, I'm not real sure what he's saying there. That is beyond a doubt, probably those three together is probably 50% of the points missed on this first paper. Students just missed that. So if you're not sure on that, come by and talk to me on that or write it up that section, especially right now when it's clear in your mind. All right, then we get into some issues, some special issues. Some of them are easy, some of them are a little more complicated. So a real simple one. I'm going to change. Y'all don't need to do this, but I'm going to change. Bill Gates thinks I want a 3 there for some reason. So he talks about mortality, the bequest motive, your risk tolerance, and there was one other I can't remember. Oh, your wealth. So mortality, your risk tolerance, your level of wealth, and bequest motive. Those are the issues he wants to bring up. And on these issues, you want to say impact on asset allocation and on amount life insurance. Some of these impact both. Some of them only impact one of them. Some of them, the article says only impacts one, or I disagree with them. I think it impacts both. Especially the bequest motive, they say it only impacts the life insurance side. I disagree with that one, but we'll talk about that. But here's these special issues where he wants to walk through his model and give examples to show you how the model works. So mortality, this one's pretty straightforward. Life insurance is a perfect hedge. That means correlation of negative 1.0 to what? Say to left. To human capital. And it's pretty obvious if you think you are going to die early by life insurance. Do you really know? No one really knows that. That's a really, really tough one. But essentially, that one's pretty straightforward. They couldn't come up a way where mortality, your view of mortality impacts your life insurance. I would say, you know, I was going to die at the end of the week. I wouldn't really care about my life and my asset allocation. I'd just be spending everything I had. But it's hard to say. I'm not really sure people's perception of their mortality, how long they think they're going to live, is a very accurate number anyway. But the key in this part of the paper is to talk how life insurance is the perfect hedge to that. And so when you're talking about the mortality issue, you definitely want to talk about that perfect hedge. And so here, the case studies, I may not be doing them in the same order. Yeah, I have the case studies in my list is a little bit different, but there's some overlap. The second issue, risk tolerance, is probably the easiest one of all. They say if you have a low risk tolerance, cannot tolerate risk well. Pretty obvious. You buy more life insurance. And what do you do with the stock allocation? Lower stock allocation. That one's like piece of cake. Now you might in your paper put in some of these graphs. They do have some charts that support their arguments. So here's the risk aversion. As your risk aversion goes up, so you see, this is how much life insurance you have. This is your risk aversion. This is your allocation to stocks. So let's see. So your face value of your insurance, as you're more adverse to risk, you're going to buy more life insurance. So if you're very averse to risk, you have a lot of life insurance, make sure I got the right one. So the life insurance is the bar, all right? And this is your allocation to the risk-free asset, not the stocks, but to the risk-free asset. If you have if you can tolerate risk very, very well, then you're going to have a lot allocated to the stock market and a very, very low asset allocation to life insurance. If you can't tolerate risk, you can put more in the risk-free asset and you're going to have a much higher allocation to life insurance. Your level of wealth. This one's controversial as well. You might disagree with them on the level of wealth. For life insurance, it's pretty straightforward. High wealth, less need for life insurance. You, in essence, self-insure. You got enough money to leave your heirs, so there's no reason to have life insurance. But they do say lower allocation to stocks. You might disagree with that. The people that are wealthier and put more in the stock market, that I could see either way. You might read what they say there in that part of the argument. But their argument is if you have a high wealth, sticking money in the stock market, you're putting a lot of risk. It's something you're only, you have plenty of money, you can live comfortably. Why put that at risk? So people with high wealth tend to have a lower allocation to stocks. I'll talk maybe one other side of that argument when we talk about the bequest method, but that's generally the discussion there. I think he has a chart on that, but I'm not sure. I remember seeing financial wealth. So yeah, as your financial wealth goes up, your need for life insurance comes down. And I think what's confusing in these charts is the line going up is you're putting less in the stocks, more in the risk-free assets. So make sure you know this percentage here is how much you're putting in the bonds. So if you have a lot of wealth, you want to have more in bonds and you don't need as much in life insurance. All right. Y'all see how these charts work? They're a little bit confusing because you got the double bar line. You can disagree with them, and I'll talk about in the bequest motive where you can disagree with them on that. Everybody with me so far? All right, the bequest motive, they say only impacts life insurance amount. I disagree with them on that. And I think it impacts the wealth side. So when wealth gets so large, the owner knows most of it will go to heirs. They most likely will invest more in stocks. I had this discussion with a very wealthy man here in San Antonio. He knew that his wealth was, I don't know, 70, 80 million bucks. Pretty good wealth, more than he and his wife needed. And his health was good, but not great. So he probably wasn't going to live at the 90 or 95. So he had plenty of money to make it the rest of his life. Very, very impressive man. His whole life story, you could write a book. In fact, his son wrote a book that talks about his dad's life, which is really fascinating. But really struggled, came to the United States, really struggled, but worked his tail off. Very smart guy, made a fortune off of one business, started a second business, made a fortune off of that. But now he's got plenty of money. He could probably live comfortably off of 5 to 10 million bucks without much sacrifice at all. So he's leaving 50, $60 million of his wealth to his children. So how can he invest? Well, he should invest as if he's investing for his children, not for himself. So I think the bequest motive, if you're not only desiring to leave a lot to your kids, but you know you're going to leave a lot to your kids, the asset allocation becomes your kids' allocation, not your allocation. And if they would have put a lot of money in stocks and you know it's going to them, you might as well put a lot of money into stocks. So that's where I have a little bit of disagreement. So they say bequest motive has no impact on the asset allocation. I think there comes a point when your wealth is large enough that you don't even view it as your wealth anymore, and you essentially assign it to your kids, even though you're still managing it. They ignore that. Maybe they're talking to normal people who don't have 70, 80 million bucks, so don't have that problem. Just normal people, but I do think the bequest motive at certain levels can certainly impact the asset allocation piece. All right, read those cases. You're going to see the article breaks it up a little bit differently than I do, but I think when you really look at it, that the combinations of wealth and risk tolerance and the other things, you end up with my 4 cases, even though they say there's 6 cases. But read it. If you disagree, feel free to have a different discussion. The obvious thing on bequest motive, obviously, if you want to leave a lot to your heirs, you will buy more life insurance. I mean, unless your wealth is just so great, you don't need that life insurance. But yeah, the more you want to leave to your heirs, the more life insurance you're likely to buy. So there's a direct correlation there. I think he even has a chart on that one. That's somewhat of an obvious chart. Now there is one last piece in the next article. Is optionality. I don't know if I have the second article loaded or not. I think I do. Yeah, there. I got that article loaded twice. So this article here, it's only 1 page. Human capital is an asset, but this article is saying it's an unusual asset in that when you're young, it's like a bond portfolio plus a bunch of options. Now, I don't know if you know what an option is. We're going to talk about options later in this class. For you actuaries, I'm going to talk about annuities as being a short strangle on interest rates. If you don't know what a strangle is, but annuities are a very, very risky product. It's a really good thing to know in interviews because it's a pretty unique kind of a nuance. But I'm going to show you mathematically that the annuity business is really, really risky. They're betting on interest rates in a way where if interest rates get really volatile, they lose a lot of money. So optionality is pretty important, but we'll get into that later in the class. But here, just basically, y'all probably have heard of options in the investment market. So you pay a premium, you have the option to do something. If it's in your favor, you execute it. If it's not, you just lose the premium. Very similar to insurance, right? You buy auto insurance and you pay a premium. If you don't have an accident, then you just lose that premium. But if you had an accident, you get paid off. So an option is when you're paying for something, and if something works out, you get a big benefit. If not, you just give up on it. So optionality in human capital, and that's the way to think about it. Optionality in the asset, human capital. It's the ability to change careers. This one goes through life. The ability to change careers. The more ability you have to change careers, the more optionality that you have. And I think up here on the discount rate, I said optionality and I put it under the numerator. I really think it belongs on the denominator because more optionality means lower risk, human capital, and a lower discount rate. Human capital is more valuable because it's less risky. You can change careers and go from 70,000 a year to 120,000 a year. Yeah, that's pretty cool. So which careers have the most optionality? You probably should think about that when you're picking your major, because you want to pick a major that has optionality. So we have actuaries in here and we have finance people in here. I think we talked about this before. Who has more optionality, a finance person or an actuary? Yeah, definitely actuary, no question. I think I mentioned an actuary from this class is working for the Citadel in finance, making a fortune, making a lot more than he could have made as an actuary. He could have gotten that job as a finance person, but there's no finance person that could have said, oh, I'm going to work for Citadel, or I think I could become an actuary for an insurance company. No, they're going to be at Citadel or not an actuary. There's no way I could have switched. In my 20s, I was talking about actuarial science. Our CFO was a finance and an actuary. And when I started talking about actuarial science, he started bringing me books. I decided, no, I don't, that's just too many exams. I don't want to do that. But it does have a lot more optionality to it. The guy who took my place at USAA was a life actuary and he became head of equities. So when I retired, in fact, one of the reasons we hired him is he was an actuary. And I knew how good actuaries were at math, and I thought it'd be great to have him come in, get some quantitative people in that department. So he went from actuary to the investment side. And I've known several actuaries. The most irritating thing when I was in the life insurance company at USAA is that the life insurance actuaries started taking the CFA exam. So you have the CPA exam, the CFA exam, and actuarial exams. Which one's the hardest? Actuarial is the hardest. What's the second hardest? CFA, what's the easiest? CPA. So I've got two of the three. I got the CPA and CFA. CPA, I thought it was a really easy exam. You study, pass it all at once, not too tough. I thought the CFA was a really tough exam. The life actuaries started taking the CFA and they passed it with almost no study. Irritated me to death, but it was an easy exam. Why? Because the actual exams are so difficult. So you can see that ability of them to take the actual exam and then they take the CFA exam wasn't that difficult. They had a lot of overlap between what they were learning and being able to go into other fields. I could not possibly take the actual exams right now. It'd be just insanely impossible. So actuary is actually a pretty good field, especially now that AI and decision science and all this stuff is taking over the world. Actuaries tend to be very good programmers. They tend to do really well. They kind of are automatically doing AI just as part of nature of their job because there's so much statistics in their job and there's so much AI and statistics. So an actuary has much more optionality than probably a lot of fields. Engineers have a lot of optionality. There was a time when I was at UTSA, the majority of the finance professors at UTSA were engineers that switched to finance. How many finance people switch mid-career to go become an engineer? Do you know anybody? Doesn't happen very often. So you see what is the key to optionality? It's mathematics, isn't it? Math and statistics. Those are skills that you have. If you have them really well, you can switch, which means why for finance majors? We were talking about this earlier. I was talking to someone in the class earlier. If you can get a master's, what should you do? Don't get a master's, don't get an MBA, don't get an MS in finance. Do what? For a finance major, you better get econometrics or decision science or programming. You better get something outside of finance that's much more quantitative. Why? Because of the optionality. You need that ability to switch into other fields. So optionality is important. He also says human capital optionality has time decay. What is time decay? Well, if I buy an option on a stock, so let's say there's a stock trading for $100 and I buy an option that gives me the right to buy that stock for $110. Well, I'm not going to execute that option. It's only trading for $100. So I can buy the stock for $100. But there's a chance it could jump up to $150 and I'd be able to ride it by for 110. That'd be pretty good. If the option expires in 2 years, there's a good chance between now and the next 2 years that stock's going to be well above 110. And so I would execute the option. If the option expires tomorrow, how valuable is it? Not very valuable at all, right? It's very unlikely that stock's going to jump. So as you get closer to expiration, what's expiration in human capital? It's not when you die, it's when you what? When you retire, right? So as you get closer to retirement, your optionality declines. And as you go through your chances of radically changing your career in your 60s is much lower than in your 20s. So it has time to decay. So how does he bring this all together? So this second article makes a few points. He says for most, human capital is more bond-like than stock-like. For most, not for everybody. We talk about some people, and bring this back to the first article. What's more stock-like? Maybe human capital is very volatile and highly correlated to the economy. More bond-like would be more stable and not highly correlated to the economy. All right. So he's saying for most people, human capital looks more like a bond than a stock. Therefore, young people can allocate a lot to stocks. Very key for your paper. We'll see that in the rubric. This isn't what financial planners say. Financial planners say stocks get less risky the longer your horizon, which is absolutely false. Stocks get more risky the longer your horizon. Now, maybe I'll show you mathematically because I know people don't believe me on that. The reason young people buy stocks is because they have this massive asset called human capital that's more like a bond than like a stock. So they can be risky with the part they put into your portfolio. Can you make that really clear in your paper? And human capital thus is like a bond portfolio plus options that decay as we go through careers. So getting more precise on what human capital is, it's the present value of your earnings, which looks like a bond, but it also has this optionality, which is a very valuable thing. But that optionality decays as you age. It's smaller and smaller. I think this is a really great way to think about it. I wish finance planners would think about it this way because I think this is a pretty healthy way to think. I think it's a very healthy way to think about your careers as well. You do need to think about optionality in your careers. I started off in accounting. My thought was, it's kind of scary to say this now, my thought was I was going to be an accountant for 50 years. I'll probably have a nightmare tonight, having said that. But I was an accountant for 2.5 years. I was really good at it. I really enjoyed it. I was moving up. And just out of a whim, I went into finance. It wasn't a choice. I just kind of accidentally fell into it and then fell in love with it. I loved it a lot more than accounting. Accounting bothered me because early in my career in accounting, I remember one meeting, my boss was sick, so I had to present, and I was a nervous wreck. But I present, and our annuity sales were higher. And I said something really stupid like, our annuity sales are higher because we sold more annuities. The president was like, speed it up, please. But it's like, and as an accountant, all I was doing is saying what people did. In finance, I was one of the people that was doing this stuff. And I was like, that's a little more exciting. I want to be the person doing stuff that the accountants are reporting versus being the reporter. So it's a little more exciting, pretty cool to do. So I didn't know that though when I was where you are. So I just had to fall into it. But we really should be thinking about this with our careers because it is pretty important. They say do what you love and you'll never work. a day in your life, but most of you are not going to do what you love. You're going to do what you somewhat are interested in, you kind of like what you can tolerate. Most people, they'd rather be doing something else. That's why I retired at the age of 46, because I'd rather be doing this than what I was doing. I loved what I was doing at USAA, but I love this a lot more. But you got to find something you can tolerate, you enjoy. It's going to be stressful, but you love it enough that you can get through the stressful times. But you also got to think about the optionality of it. What can you do if you get tired of this career? How can you merge to something else? And certain jobs will lend themselves a lot better to that than other jobs. The more math, the more statistics you have, the more optionality you have. But the last thing he says is, as optionality declines in human capital, and as human capital declines, they're going to say something really critical here. I kind of have that backwards. Replace bond-like human capital with bonds in your portfolio, and replace decaying options in human capital with options in your portfolio. So as you age, your human capital is getting smaller. So what do you need to do? Human capital looks like a bond or bonds in your portfolio. As you age, the optionality of your human capital declines. So add more options to your portfolio. That's what the second article is saying. I agree with this. I disagree with what they say this means. Anybody know what they said here? What do they mean by putting options in your portfolio? Y'all see the word there? Y'all see that? Active management strategies have option-like characteristics. What is active management? What's passive management? How would you do passive management? You'd buy what? Go to Vanguard, buy an S&P 500 index fund, just buy the market, passive, real cheap, very inexpensive. We just did that today. We executed our $2.5 million stock portfolio for UTSA. We bought all exchange traded funds just to match the market. We're going to get active once we get the class going and start picking stocks. But right now we're passive. Passive means you just buy the market. Active means you're going to hire someone to try to beat the market. So what do they mean by adding optionality? More active management. I disagree with it, but that's what the article says. I don't believe in active management. The statistics are overwhelming that most people should just be buying passive management. Why? Because it's cheaper and it actually outperforms quite significantly over time. Usually beats active managers about 90% of the time. Why? Because you buy a Vanguard passive mutual fund, it charges less than 0.1%. An active manager charges 1%. So active manager charges 0.9% more. You're more than likely going to beat the market because you're starting off with a 0.9% advantage. What do I mean? I do agree you should put more options in your portfolio. What do I mean by options in portfolios? Actually add options to your portfolio. Stock options, index options. We're going to talk about this because we're going to talk about equity-linked annuities, a product I hate, but a concept I love. I hate the product because it's terribly mispriced, but the concept I really love. So I actually think, in fact, if you take my risk management class, some of y'all might have, I can't remember my risk class, but oh, you were, oh, that's right. Yeah, you're on the left side. I knew it. So in that class, I talk about for people in their 60s and 70s, back in 2020, when interest rates were like 0.1%, 0.2%, why buy bonds? You're getting nothing. So I was recommending people like that, just put your entire portfolio in the stock market and buy options to protect yourself. And you would come up with a higher return with less downside risk. So there are times where I think just put options in portfolio. So options are like insurance. You can buy insurance that protects you when the stock market crashes. I actually think that makes a lot of sense for older people. And we're going to look at this a little bit. I'm going to show you a special product later in the class, which is somewhat similar to this. So I like the idea of putting options in your portfolio, but I don't like active management. I like the actual idea of buying insurance, buying protection for your portfolio. We'll see it when we do equity-linked annuities. Miles?
Buying options is like
Well, if you can be active buying options, no question. And I do think you have to be diligent. You can't just buy them and not watch them. You gotta, unless if you're active so much as you have, there's certain times where you almost have to trade just because of where the options are pricing. You might argue that the average person can't do that. So we'll talk about equity-linked annuities. At USAA, we tried to introduce a stock portfolio with options. I thought it was a great product, but it was terribly mispriced. My boss wanted to put 1% management fee on it, which was terrible. And then the lawyers wouldn't let us sell it to the common person. We had to sell it to sophisticated. So the whole thing just blew up. But I do think this product can make a lot of sense. I'm not sure. We'll see when we look at equity-linked annuities. Can an average person on the street actually do this? Or do you need an investment professional to do it for them? There is a portfolio out there that hasn't performed all that well called the Gateway Fund that does this in a mutual fund. You might look it up, and it does it with no active management at all. They have a very strict rule they follow every month. I wouldn't quite do it the way they're doing it. But right now is not a bad time to buy options. When are options expensive? Yeah, so when volatility is high, so volatility has come down quite a bit here recently, which doesn't make a lot of sense given what's going on. So here's where we are on volatility. When volatility is low, buying options, buying that insurance protection is really inexpensive. When volatility is high, it's real expensive. So the Miles point, I don't want to put myself in a position where I got to roll over the options right here, because that's going to kill me. So you got to be somewhat active in the roll, so that, and the way we did it at USA, we made sure that we're rolling at least a month early, so we had some time just in case the market shot up like that we have some time to move. And you're trying to capture that time decay. But yeah, I mean, it's right here would have been a great time to buy insurance protection for your portfolio, because it would have been really cheap. And then when that liberation day came along, you would have been really well protected. And obviously you look at COVID. There's COVID. There's the 2008 crisis. There's the 9/11. I mean, there's the yeah, I guess that's probably 9/11. No, that's the 98. That's the .com. So when this number is low, especially when if it falls below 10, I'm always buying options. It's like when VIX falls below 10, it's like buying homeowners insurance. And you call up the company and there's a fire right outside your house. You call the insurance company and you say, "Oh, we got a deal today. If your house burns down, we'll build you 2 houses." That's what a VIX below 10 is. You say, "Well, there's a fire outside my house." Yeah. We'll buy you 3 houses then. It's like, I don't think you get it. So when the VIX is low, what does that mean? That means no one's worried about risk. When should you be worried about risk? When no one's worried about risk. When is it cheap to buy protection against risk? When no one's worried about risk. So when the VIX is below 10, I'm always buying options. It's a wonderful thing. We did it in our student portfolio. There's a few years ago where the VIX fell down to 9 something. We doubled up on options because they're so cheap. And then that's when the Tokyo earthquake hit and stock market shot down. The market dropped 11%. We went up 11%. It was kind of pretty cool just because insurance was so cheap. So to Miles' point, yeah, Miles, I think you got to be real careful with this because it does shift so fast. And you can't get yourself in a position where you're rolling over and something like that. If you're rolling over here, you'd probably just not buy the option and just kind of ride it out because it would be so expensive. All right, so you see two things here. Human capital and optionality, you need to discuss that fully. That's in the second article. And then I also want you to talk about why do young people put so much in stocks? Make sure you have that really clear. It's because human capital looks like a bond for most people. Thus, they can put more of their portfolio in the stocks. Make sure you have that in your answer. That's what the article says. Questions on that one? That one, you'll definitely find in the article pretty easily. The last thing to talk about, which is pretty straightforward, but do read the paragraph and summarize it. It's pretty obvious, but the first article says more research is needed. You don't get credit if you just say more research is needed. So what research is needed? And they tell you, you can even just search on the word research. So this paragraph here, just look for the word right before the appendix. One possible direction. They tested annual term insurance. What would happen if you did level term for 10 years, or if you did whole life insurance? What if you did other types of life insurance? How would that play into this? We'll talk more about whole life. Another direction would be utility models. That's been really debated. How do economists measure happiness and contentment? Are there other models to measure that? So those are the two big things they say. We kind of implied in class some other things to think through, like the bequest motive when people have a lot of wealth. There's other things to think about. Remember, you don't need to read the appendix unless you just want to. The appendix just shows you that there is more math to this and it can get pretty complicated. And adding other life insurance, especially if we're going to talk about whole life, that is itself both life insurance and an investment. So that's why it gets really complicated. Whole life becomes part of your portfolio, and sometimes it can be more bond-like and more stock-like. So the life insurance industry, and we'll talk about this on Thursday when we talk about the ethics of life insurance. Life insurance has become so complicated. This model becomes much more difficult. You add these other types of life insurance, so it's pretty rough. All right, so next Tuesday, we'll do the easier article, the third article, the easiest one. I think you're going to find that one's pretty straightforward. I'll tell you some of the traps students miss on that one. So any questions? When should you write your papers? Yeah, this weekend or tomorrow, what's fresh on your mind, and then bring it to me next week so we can walk through it. All right, I'll stop it there. Make sure I got you on attendance. So tonight, what we want to do, so you got everything you need for paper one. If you want to show me your drafts next week, that'd be great. Or even sections of it. We'll talk the last article for paper one on Tuesday. So you have everything you need for paper one for the first part. So we'll finish that up. Tonight, what we're going to do is one of the essay questions for exam one. And we might do the essay questions in class. I have since COVID, I've done them online, but I'm a little worried about AI and online papers and that kind of thing. So we might be doing them in class. So I'm going to show you what I give on the exam review. You don't need to write this down word for word, but you definitely want to get this rubric in. It will be on the exam review, but I'm going to go through each section of this. So what we're going to talk about is the history first. Now here's where, I may offend some of you if you're in this industry. Be real careful if you interview in this industry that I don't corrupt you too much. My goal, because I have so many concerns with finding, and y'all listen to, or y'all watch my podcast, or you listen to or you read the blog, pretty negative stuff. I like for students to be skeptical, but not cynical. You're too young to be cynical. but you should definitely be skeptical. And talking to Jonas last night in the industry, I was like, is this even solvable, or is this thing so massive and so complex we'll never have a solution? He says, we got some solutions that are working, and it is beyond complex. So you should always be skeptical of anything in finance because the incentives are often misaligned, and it's really hard to fix incentives. Kahneman is a really famous person in finance. He won a Nobel Prize in economics. He's not a finance person, but he won a Nobel Prize in economics with prospect theory. What prospect theory says is we react much more strongly in a loss situation than we do in a gain situation. And what that means is when you have rent seekers, a rent seeker is someone who's in an industry and they're making money, their incentives are, they know how to make money out of the system. And they're the ones whose incentives are horrible, but they're the ones that have a lot to lose. And because they have a lot to lose, they fight a lot harder than those of us who have something to gain out of fixing the system. And that's always the problem. The people that have the bad incentives that are making a fortune, they're going to fight hard to keep what they have. And those of us who benefit by fixing it, we don't fight nearly hard enough. So it really, really is hard to fix the healthcare system because we have these really bad incentives. Same thing with the life insurance industry, really bad incentives. But it didn't start that way. So let's talk about the history. Before 1980, this industry was pretty boring, pretty respectable. They had some issues, but not nearly what we had today. And so what your question is, what's the history and then what happened in 1980? Okay, and then how did the industry respond such that now we have these incredibly horrible products? And I think they're incredibly horrible. We will next week look at, or maybe not next week, but pretty soon we're going to look at the equity-linked annuity, which I think is probably the second worst product in existence in the financial services industry. There may be something worse, like, there's so many really bad ones out there, but really horrible product. But it directly aligns with what's going on here. All right. And you saw some of that in the blog, definitely. So the first thing is the history. So before 1980, this was an industry that sold term life insurance and whole life insurance. Really basic, boring stuff. Term life, we'll talk about, that's insurance that you get for 1 year or 5 years or 10 years. If you die during that time, you get the benefits. If you don't, and insurance just cancels and you're not covered anymore. Whole life is you pay a premium for you until you die, and then you get the insurance. Covers your entire life. Whole life was really, really boring in that you paid a premium, it was fixed forever and ever. If you decided you didn't want the product, some of that premium went into a savings account for you. And so if you say, you know what, I don't want this product anymore, you might get $20,000 back or $35,000. Anybody know what that's called? What's your savings account called in life insurance? Initials are CV.
Cash value.
Cash value. Yeah, you get a cash value. Term insurance doesn't do that. If you cancel your term insurance, you're done. There's nothing else. But whole life, you're both buying insurance and you're putting away some savings. So if you cancel early, you get some of your money back. And those are the only two products. Really boring stuff. So what happened in 1980? There were two disintermediations. So what is a disintermediation? So intermediaries are those are between two groups of people, and that's the financial services industry. It's banks, insurance companies, mutual fund companies, investment firms. They're between investors and spenders, borrowers and spenders or lenders. So, if you had, let's say you had $10,000 you want to invest, you could go up and down your street knocking on doors and say, hey, 10,000 bucks. Any of y'all need to buy a car? I can loan you 10,000 bucks. I'll charge you 8%. And your neighbor says, well, yeah, I'm buying a car, but it's a $17,000 car. You say, well, okay, let me go find someone who has 7,000 bucks, and the two of us will loan you 7,000 bucks. Is that something you want to do? What would be a lot easier? You go to a bank, give them your 10,000 bucks. What's the bank going to do? They're going to loan out money for people to buy a car. They're the intermediary. They bring the borrowers and lenders together. That's an intermediary. So what is disintermediation? It's when people take money out of one intermediary and move it to another. They take money out of banks and give them to life insurance companies. They take money out of life insurance companies, give them to investment firms. So in 1980, the life insurance industry had the worst possible scenario. They were getting disintermediated by banks and by investment firms. People were taking money out of life insurance companies. So anybody, well, you're way too young. Boy, I used to say things like, remember when Carter was president? So, that was 20 years ago. And even 20 years ago, they were only babies at that time. So y'all probably don't even remember that Carter was president. But he just passed away last year, right? Or this year at 100, close to 100 years old. Great guy. But what was his big problem? Huge what? High inflation, high interest rates. If you're an insurance company and you're selling a whole life policy that's paying your customer 4%, guess what they're going to do? They're going to take their money out and they're going to go invest it at a bank and get a CD paying 15%. When I graduated from UT Austin, I hate to tell you all that. Anybody want to guess what my hourly tuition was in 1985? Guesses. What was UT Austin? What's y'all's hourly tuition? Y'all even know? How much you pay per hour? It's over $100, isn't it? $1,000 per hour? Maybe. I don't know. I haven't kept track. Someone should Google it, but 123-hour class. Oh, that's $40. Right. So my tuition was $4 an hour. So if I took 15 hours, that's $60
86 to 550
per hour.
per hour, per credit hour.
For credit hours. So I paid $4 for credit hours. So 15 hours, my bill for a semester, $60, and then there'll be building fees and other stuff for another $50. Books for 15 hour. How much you think books for 5 classes cost me? My entire bill. Not quite that low, but I remember one semester it was over $100, and I was like, my word, I'm spending over $100 for books for 5 classes. That's ridiculous. This is insane. Who would spend that much for a book? So an entire semester altogether might be $300. And I was living at home with my parents, so $300. So when I graduated from college, I had money in the bank. I was working, I was taking trumpet lessons. That was paying me $15 an hour, which today would be like $80 an hour. I was making really good money teaching part-time. So it was great. So I had money in the bank. I had a CD mature. I go to the bank, say, I want my CD money. I'm moving. And they say, well, we got the CD at 15%. I go, 15%? I don't want 15%. That's not any good. So that's the market I came out of. 15%. You could buy a 30-year treasury making 15, 16%. I mean, that's pretty good investment, right? Lock in 15% for 30 years. Interest rates are really high, but you got a business that was paying their customers 4%. Why were they paying them 4%? Because when those customers came to them and gave them their money, the life insurance companies are going out and buying corporate bonds yielding 6%, 7%. So they could only pay 4%. And the interest rates shot up. They could still only pay 4 or 5% because they had the same bonds they bought years before. But the banks who paid current rates, they could pay 15, 16%. So the life insurance customers are like, why am I going to sit here and make 4%? I'll take my money out. And even better, they didn't even have to cancel the insurance. They could actually borrow their cash value. So they might have $30,000 in cash value. They could actually borrow that $30,000 in cash value, give it to a bank and make 15%, and they still have their life insurance. So it's like everybody was doing that. And so what did life insurance companies see? They saw all this cash coming out. Now, some of y'all taken investments. What happens to a bond's price when interest rates rise sharply? Do bond prices go up when interest rates rise, or do they go down when interest rates rise? This is kind of finance go down, right? So if interest rates shoot up, bond prices shoot down a bunch. If you're a life insurance company, you own a bunch of bonds, and now people are taking money out, interest rates have shot up, what are you doing? You're having to sell a lot of bonds for large losses to give people their money back. And you're still insuring them because they didn't cancel their policy, they just borrowed their cash value. Horrible situation. That was the first disintermediation. We went from life insurers to banks because interest rates were very high. And Okay. I hit something. And Bill Gates thinks I want nothing but capital letters, and I don't know what I hit. Every once in a while I hit it and it starts typing like Russian or something, and I don't know what I hit. It still says English down here. Customers did not cancel their whole life policies. They borrowed cash value, moved money, banks, like CD rates, 15%. So they still insure these people. They still have the customers, but they're losing all the cash at the worst possible time. So a whole lot policy pays 4% and lends the cash value out at 4%. I mean, just imagine that they're borrowing their cash value and now they only have to pay the insurance company 4% and they're sticking in a CD at 15%. You'd be stupid not to do that. Right? It is just the obvious thing to do. Take your cash value off, make 15%. And so it was just so obvious, and the insurance industry really didn't have much to do to fix that. And as the cash left, insurers were having to sell bonds, fund the withdrawals. These bonds were sold at huge losses. Interest rates. He's about huge. Okay, I get the picture. That's the first disintermediation, interest rates shooting up. That's still true today. We're going to see this later. Remember, I talked about the short straddle for annuities. Annuities, especially, but it does affect life insurance as well. This is an industry that can have serious bankruptcy problems if interest rates were to shoot up really dramatically. Now, we saw that in 2022, but not anywhere near what we saw in the late 70s. So the insurance industry could see some major withdrawals if we were to see interest rates go up to 8, 9, 10%. So far, they've kind of hit at 5 and stopped. And the insurance industry can kind of handle that. It's not great for them, but can kind of handle that. But if rates were to really shoot up to 8 or 9, 10%, we have a really serious problem with inflation. The life insurance industry would be the problem, have problems. All right, let that, y'all get all that down. All right, so there's the first problem. Y'all weren't alive in the 80s, but well, who was president in 1980? Or who won presidency in 1980? Reagan. So we went from Carter to Reagan. How many recessions did Reagan have in his first 2 years? 2 recessions in 2 years. Why did he have 2 recessions in 2 years? Because what was the Federal Reserve doing? They were fighting inflation. How do you fight inflation? You slow the economy way down. So good old Reagan, he got reelected, but he got reelected even with 2 recessions his first. And essentially people let him get away with that because it wasn't really his fault. It was the Federal Reserve. If you can read, anybody remember the Federal Reserve chairman at that time? Volcker, V-E-V-U-R, I can't remember how to spell it. He has a book out. It's an interesting book. I think he passed away just a few years ago. I read his book. Interesting book. I wanted him to just write a book about 1980 through 1983, but that's like 3 chapters, and he's got a bunch of other stuff I wasn't so interested in. So I recommend those 3 chapters. But yeah, he essentially said we've got to solve inflation. So in the 70s, Nixon. This might sound familiar. Nixon came in and decided to politicize the Fed Reserve. Does that sound familiar? And what's going on today? Nixon came in and said, hey, I want the Federal Reserve to be much more dovish. We need a strong economy. I'm president. So he put pressure on the Fed. The Fed accommodated them and interest rates, inflation just shot up. Volcker comes in and says, we got to fix this. I think Volcker probably came in under Carter, but under Reagan, he said, we got to slow everything down. So we had two recessions really quickly, high unemployment, but it fixed everything. And so after that, what happened? Interest rates came down. That was nice. What else started going up? Where would you want to have invested in that time frame? No, oil was in the 70s, so that's right in the 70s. But when we fix it, interest rates came down, inflation came down, oil prices came down. Where would you want to have been in the 80s, late 80s and the 90s? Stock market. So what's the second intermediation? So there's the first one, is life insurance to banks. What is the second one then? It's life insurers to investment firms, stock mutual funds. That was the second disintermediation. So they say, okay, we got these two boring products. We got term insurance, which doesn't pay any interest rate. It just gives you life insurance. And we have whole life. It pays an interest rate. You can build up a savings account, but they're really, really low interest rates. And then you can borrow your money at really cheap rates. So we're kind of incentivizing you to bet against us, take your money out, invest it at higher rates. And they say, wow, that's the problem. And then they discover, wow, the stock market's finally taking off after a decade of a horrible stock market. Now people are saying, well, why do I have this boring life insurance giving me 4%? I can invest in the stock market and make 10%. And so people started moving their money to the stock market. Insurance companies don't buy stocks. They don't like stocks are really, really dangerous. If you took my risk management class, we talked about that. Life insurance companies buy zero in stocks. Everything's in bonds. Now you have the stock market taking off. So that's their problem. How do you fix this? There's a couple ways you can fix it. One is you can downsize fewer companies. You simply say, hey, we're in the wrong business. The world's changed. There should just be fewer life insurance companies. So we'll just shrink the industry. How many industries you think they like that answer? So there's one solution. What's the other? I'm going to be, okay, this is going to go to the cynical side. The other approach, let's just cheat. Let's see if we can get away with a sleight of hand and trick our customers. All right, so they did not downsize. Life insurance companies, they should have all consolidated, but a lot fewer of them, but they didn't. They said, we are going to jump into this market and we're going to figure out a way. And I'm going to show you how they were able to do this. It has to do with, they have one thing their competitors don't have. They have one thing investment firms don't have. They have one thing banks don't have. We'll see what that is. It's a really important advantage they have over everybody else. All right. So two disintermediations. The banks because of interest rates, the stock market. This one's because stock turns finally good again. I mean, good and again, really, if you go from 1930 through 1980, the US stock market was just horrible. Really horrible place to be. You had to sell off during the Great Depression. You had to sell off during the 70s. You really, if you bought stocks, you would have had a return lower than if you just bought treasuries, but with a lot more volatility. This is a horrible place. A lot of people have just given up on stocks. And then suddenly under Reagan's term, and I think it's both Reagan and Carter, a lot of deregulation, a lot of regulation getting done away with. We have this new spirit of entrepreneurship in the United States. And it really did start under Carter, moved into Reagan's term, and the stock market started doing well. People started investing in stocks again. So things are looking pretty good. So what did the insurance industry do? Well, they said, you know what, we're in the wrong business. We're in the life insurance business, and that's just too dull and boring. It's not growing anymore because everybody's investing, especially in stock mutual funds now. I tell you what, let's get out of the life insurance business and let's become asset gatherers. Exciting, not exiting. So insurance is boring. We're offering these products. There's no one wants to talk to life insurance about death and dying, and you die, you get all this money. And it's a pretty radical change. They started talking like they were investment people. They didn't sound like life insurance salespeople anymore. They started talking like investment people. We want to be asset gatherers. This is the key. That's where the world's going. People are getting more aggressive to save for retirement, putting money into the stock market. So we're going to change our focus from insuring to asset gatherers. And you can see it in the sales pitches. You used to dread to see the life insurance person coming back because they're going to make you feel guilty. What happens if you were to die? How would your family survive? It's just horrible discussion. Now they're saying, man, come to life insurance, we can give you all these tax advantage investments. They can rise with the stock market. They have all these great advantages. They started talking, they sounded more like investment people than insurance people. There's a huge shift. But there's a big problem. Big problem here is they had some huge disadvantages to banks and investment firms. Life insurance companies are much more expensive than banks and investment firms. Huge problem. They're buying the exact same assets as everybody else, but they have huge problems. So what are those problems? The number one problem is expenses. Life insurers have much higher expenses than banks, investment firms. Now, in your answer, you have to somewhat say why that is, but the most obvious ones is they have actuaries and they have underwriters, and they have claims. They have processes banks and investment firms don't have. Banks and investment firms don't need a team of 25 highly paid actuaries. They don't need underwriters to figure out whom they're going to insure because they don't have the life insurance piece. They only have the investment piece. So they have these higher expenses. You also have regulation, you have premium tax, you have these other things. There's a lot of expenses that make life insurance companies much less efficient than banks. So if they're both buying the exact same product, but life insurers have to subtract a much bigger expense load, they're going to be less competitive. So how do you get around that? We'll talk about how they get around that, but they're much more expensive. Not to pick on you actuaries, but actuaries are expensive, and they do make up a huge part of the expense ratio for life insurers. And number two, there are too many life insurers. We call this overcapacity. So the industry has too many players in it. They're going to try to compete. There's too many of them. They should have consolidated, but they say, we don't want to do that. We still want to compete. We still want to be all the same companies, but we want to get in this game of collecting assets, get out of the insurance business. So asset gatherers is a pretty good business. You get people's money, you invest it, and they pay you a fee every year. Nice. We've had two of our alums that started our hedge fund 2 weeks ago. They just launched it 2 weeks ago. The guy who used to work for me, he just started his, he started a hedge fund. I guess it's a hedge fund. It might be an ETF. it's kind of a cool business. A good friend of mine started a hedge fund in New York City. And I was talking to him about it, just doing the math in my head. And I'm thinking, your worst year ever is you'll make 800,000 bucks take home pay. That's not bad. Maybe I'll take 800,000 take home pay, or a pretty low key job. I mean, he's just investing people's money. He was a long short hedge fund manager doing emerging market equities. Pretty fun job. That was his worst year. Would you like your worst year be you make 800,000 bucks? Your best year might be 2, 3 times that. That's a pretty good job. Just manage people money. That's what an asset gatherer is. They just take people's money and they pay them a fee for managing the money. I visited his New York office, and I mean, you could have played a tennis game in there. He had 2 employees. It was him and one other employee. Like, what? And it cost him 7,000 bucks a month for his office. Like, why don't you just work from home? Oh yeah, it's just 7,000 a month. Yeah, but so that's how wealthy he is. It's like, it's 100,000 bucks off. It's like, yeah, you could just work from home and not put up with it. So it's a pretty good business. You don't have underwriters, you have actuaries, you're not worried about people when they die. They just give you money, you invest it. As long as you're a decent investor, they keep paying you money. So it's a pretty good business. How does the life insurance get in this business when the business they were in before was boring life insurance? All right, so we got the history, the disintermediations, and the industry says we got a disadvantage, we got to overcome this disadvantage, or we got to downsize. We're not going to downsize, so we need to overcome this. So what's the next part of this question? How do they overcome? What tricks did they do to figure this out? Do you have any solutions? How would you have fixed this? It's a pretty tough question. It looks pretty hopeless, doesn't it? You would think they say, you know what, people don't need as much life insurance, they can buy more equities. Let's just cut the industry in half. All right, so let's see. It's kind of surprising, right? Let's see how they get like, there's no way they could have done it, but they did it. All right. There's a little bit of redundancy in the answer. But the key is this word right here, complexity. Life insurance products became ridiculously complicated. I might bring in my mom's U-Life policy and let you see the wording on that thing. It's not wording a human being would understand. I should copy and paste it in the chat GPT and say, hey, can you figure that, chat GPT and Notebook LM does a good job of summarizing stuff for you. I should have tried that. I was trying to figure out her policy. I sent the company some questions and their answers back. Like, why would you send a retail customer that document? But it made no sense. It was just crazy. So complexity. How does complexity help? So let's look at this. So the complexity does what? Makes comparison shopping. What word am I going to use? I tell you, I'm not going to use the word difficult. What word do you think I might use instead of difficult? Impossible. Yeah. I don't know why it's not. Oh. I like the word impossible. Difficult might be okay, but I'm going to say impossible. What happens in an industry where you're selling products where you can look at the products of 10 companies and there's no way to know which company's product is best? That's pretty bizarre industry. You buy auto insurance, how hard is that to do? Y'all probably don't shop your auto insurance. You should. Geico, Farmers, Allstate, USAA, State Farm. You should. I recommend people every 5 years go out and price. I'm with USA, so I'm a little sloppy. But you can go out and shop it pretty quickly and just see. It's not that hard. Auto insurance, you got part A, B, C, and D. You can shop each piece independently and just see. I only buy A and D anyway, so it's pretty easy to compare. It's a little complicated because you have different limits and deductibles, so it can get a little complicated. But there are places on the internet like esurance.com where they do the comparison shopping for you. That's owned by Allstate, so you might think it might be a little biased, but there are a way to compare. Term insurance, we'll talk about that. Term insurance, very easy to compare. You buy a term life insurance policy, the best one's the cheapest one. No question. These products they're creating, the only way, and we'll see it, we're going to read an article, the only way to compare them is to run like 10,000 scenarios and look at it stochastically as a distribution. How many retail investors in the United States have a model home where they can run 1,000 scenarios of interest rates, stock markets, and it's crazy. It's really difficult. So comparison shopping is impossible for the complex products. Now the products that were selling in the 70s, term and whole life, very easy to comparison shop. Like whole life, when you buy whole life, the premium is set for your entire life. It never changes. So if it's $50 a month, you're going to pay $50 a month. And there's an interest rate embedded in that you get in the cash value, and that's fixed. So you're going to make 4% a year, and your premium's $30. You know what your cash value is going to be. It's all set up front. So what's the best whole life policy? Well, you got to look at the premium and look at the cash value. Say, okay, the premium's $50 and the cash value is going to grow up 4%. It's a little complicated, right? Another one may have a $40 premium and a 6% rate, but it's not impossible to do the comparison. You can kind of get a good sense of which one's the better product. The term's the easiest. Term, you just have a premium. Just like with your auto insurance. You look at 3 auto policies that have the same coverage, just buy the cheapest policy. It's really straightforward. These products, these new products, have so many bells and whistles. It's impossible. And I'll show you some examples of why that is, because it's really tough. Questions up to there? Are y'all staying with me here? Second issue here is information asymmetries. The seller knows more than buyer. For capitalist systems to work, you really need a pretty good balance between buyers and sellers. So that we'll talk about this with health insurance. You need it to be a good balance. You go to your doctor and she says, you need this surgery. You'll need to stay in the hospital for 20 days. They say, yeah, you know what? I don't think I need that surgery. And if I do, I think 10 days in the hospital is fine enough. Is that the conversation you have? What do you do? Oh, surgery, 20 days. Okay. Now, what keeps a doctor from saying, what if you really need surgery and you need to stay there for 5 days? So the doctor says 20 days. Why would the doctor maybe tell you 20 days? You make more money if it's 20 days. So is that fair? Can you debate that? Are you going to say, no, I think I'll just stay 5 days? And what they discovered is hospitals with an under capacity of beds, they don't have enough beds. Guess what the average hospital stay is? Really short. Hospitals that have too many beds, guess what happens? The doctors are like, hey, you need to stay here for 20 days. Is that because they need to stay for 20 days or they need to fill up the hospital beds? That's information asymmetry. Same thing on the life insurance side. The salesperson knows more than the buyers. The buyer really can't challenge things. And we'll talk about some of the sales tactics to get the seller that advantage. But yeah, huge advantage. We're going to see that on healthcare side, but definitely an issue on these life insurance products. Another issue is salesperson. Word. I don't know what buttons I'm hitting, but Bill Gates doesn't like it. So how the salespeople are trained and the practices they follow. So this is a huge part of life insurance. We're going to talk about commissions here pretty soon, but these are salespeople who have a unique advantage over banks and investment firms. it's highly unlikely you're gonna have a person knock on your door to sell you bank products or to sell you investment products. But a life insurance person, these are agents out there, they have an incentive to sell, they give huge advantages, commissions for selling. So you might say some questionable claims. I'll give you some examples later in the class when we get into some of the products specifically. My brother, older brother, we have this deal. He doesn't like to tell people no's, and so anytime he has an investment or insurance question, I have to be there in the room to make sure he's not going to be, oversold. And I've had some really rough. I don't want to be mean and cruel and all that, but it's like some of the things I've heard. I was wishing that was during cell phone times, and I could have recorded it and sent it to the insurance regulators, because it was shocking what these salespeople would say. It's pretty shocking. I'll give you a few of them because some of them we'll see later when we talk about some of these products. Some of these claims is like, I can't believe you just said that. So one of them said that a bank CD is riskier than investing in small company stocks. It's like, yeah, I don't think so. I don't think you can fake that claim, but yeah, so interesting claims. Some of their claims, when they say it, it's so complicated, and especially to do this with senior citizens. They'll say something really complicated that they know the person doesn't understand. But have you ever had this where someone says something to you that's so complicated, but they say it in a way that it sounds so obvious? And what do? You go, oh, and you say, yeah, that's interesting, right? We don't want to feel stupid. And that's part of the tactic. You say something that's completely gibberish, outlandish, and you say in a way that, oh, obviously you understand this. And what does the person say? Oh, yeah, I understand that. Oh, so you want to buy the product? Well, how are you going to say no? Because there's no way you can defend yourself because you have no clue what the person just said. So sometimes it's not only questionable claims, it's just gibberish. I had some good friends of mine, they bought one of these horrible products, and then they told me about it afterwards. And it was very awkward for me because they bought probably the worst product that's ever been developed on the life insurance side. It was a horrible product. And he's showing me, look at this, isn't this a great product? Like, and I don't know what to say. I was tempted to say, are you still in the kind of tryout period? Because you can get 30 days where you can change your mind, but oh. And so a few years later, they called me and said, this product's been horrible. We want to get out of it. I said, yeah, you probably should. So I said, I told them back then, I don't know, we weren't asking for, they just wanted me to say it was great because they kind of already overcommitted. It was a horrible product, but what he was saying about it made no sense. So I said, bring me a policy. When I saw the policy, I said, oh yeah, okay. This is life insurance, but really complicated life insurance. You don't really need this much life insurance. If you die, your wife's gonna be really happy. I mean, financially happy, I guess, not emotionally. But horrible product. But smart guy, really smart guy, but he just didn't understand the product. It was just too complicated. Sorry, I kind of separated that up. Notice what word keeps coming up. The salesperson. Let's get to that salesperson. What's wrong with this salesperson? Commissions. When you read my blog, you saw that commissions was a big deal for me. If a person is selling you two products, product A, they get a $50 commission, product B, they get a $500 commission. Can you make any argument that that person's going to be unbiased? No way. I think it's absolutely impossible. We'll talk about Equilink numbers where the sales commissions can be can be $10,000. Pretty good incentive. Yeah, it's when my mom bought her policy, it's kind of ridiculous. My mom, she has two of her sons, one's a life actuary and one is me, who is an investment person and worked in a life insurance company. And they didn't come to us at all when they bought this life insurance policy. I would have recommended a very basic policy for them. She bought a really complicated product. My mom's very smart, but she didn't understand it. She thought she had bought an annuity, but she'd actually bought a life insurance policy. But the salesperson really pushed it hard. Why? Because that was a product that had a really good commission. My parents needed a far simpler product. Given what they needed, there was a perfect product for them. But they got this much more complicated product, not because it was better, it was more, it had a higher commission, and that's why the salesperson pushed it. And my mom didn't understand it. And she's actually pretty good about asking hard questions, but somehow they got away with it. So some of y'all might disagree with me on this, but I'm going to say commissions make objectivity impossible. Possible to be biased. It's interesting. There's a life insurance company that will probably approach some of you to come work for them as salespeople. How do you know it's commission sales? What's the first question? The first thing they'll ask you to do? Give me a list of what?
Friends and family.
Friends and family. Have any of y'all seen these guys before? Give me a list of your friends and family. Why are they doing that? They want to make sure you got a good network and you're sociable. Is that what they're looking for? No, that's the people you're going to sell this to. Is that how you want your friends and family to see you? Hey, it's Thanksgiving. So so-and-so's coming. Oh, great. You saw this life insurance. How much fun is that going to be? You might say, well, aren't they fiduciaries? Are life insurance salespeople fiduciaries? They're not fiduciaries. Can you get a fiduciary? You definitely can. There are financial advisors who are fiduciaries. What is a fiduciary? Every decision they make has to be what? In your best interest, not in theirs. So I was a fiduciary for USA's 401k plan, pension plan, and other things. And I used that to my advantage. There was things USA was doing that I said, no, we're not going to do that. And I could argue that's not in the best interest of participants. They tried to do some bundling. Bundling is a terrible thing. If your company's doing bundling, they're ripping you off of your 401k, but they want to do bundling. Why? Because it's in the interest of participants? No, because it's going to save USA some money. I won that argument. I was going to follow my sword in that argument, but fortunately, one of the presidents didn't like it either. So I was ready to go to battle, and I won that battle because someone else fought it for me. But yeah, I mean, I was ready to go to battle. So I was a fiduciary, and I saw us doing things where it was obvious we were doing it for USA's benefit. And I could always win that battle because I just say, hey, we're fiduciaries. You've got to make the argument that it's not that it has to be generally in the benefit of the beneficiary. It has to be, what's the word? You mean the word? Blank to the benefit. What's that word? Mostly to the benefit? Over 50% to the benefit? What word is it? Solely. What does solely mean? Can it be 90% for the beneficiary and 10% for the company? It's be 100% beneficiary. And I even talked to my lawyer. There's something I wanted to do for our health plan, our post-retirement health plan. And it was 90% to the benefit of the participants, but a slight benefit to USA. And the lawyer's like, no, it's got to be 100% beneficiary. Life insurance sales, people don't have that. What is their standard? What, anybody remember? What is their standard? They have the suitability standard. We probably will finish. I see how worked up I get about this. I'm really emotional about this. I hate working for an industry that rips its customers off. I'm not saying the whole industry does, but there's a big chunk of it that does. Even USA, which is owned by its customers, 90% was, yeah, pretty good stuff. But every once in a while, the temptation was, if we do this, it really makes our numbers look good. It's like, no, We're owned by our customers. We shouldn't be stealing from our customers to benefit our owners because they're the same people. We should always have great products. What is suitability? Suitability simply means you can come up with a scenario this product would be suitable for a person like this. This type of product too, not this specific product. The product you're selling can be horrible, mispriced, horrible product. But if there's a product out there like this product that could make sense for a customer like this, that's suitable. All right, that's a pretty weak standard, isn't it? It's like you don't have, I mean, you can almost argue any product for any person. So the product I sold my mom was suitable, but it was not the right product for her. If she had asked me and my brother to come talk to her, we would have gotten her out of that situation. It was very obvious the salesperson was thinking commission, 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 and wasn't listening to what my parents needed. And I'll show you that product because we're going to talk about it. It's one of the first life insurance products we're going to talk about, that really horrible product. So I'm going to argue that commissions, where the commissions are different product by product. Now, if the insurance company said, hey, we'll pay you $100 commission for any product you sell. I'll say, yeah, that's a good. Product A, $100. Product B, $100. Product C, $100. I'd be okay with that. But when there's a tenfold, thousandfold difference between commissions for different products, I'm going to argue it's impossible. Now, the life insurance person, I think I've told you about her. When she came in, her first statement was, your students say you hate me, so it was this person. And I told her how much I dislike commissions. Her comment was, oh, we've changed that. We now base our commissions on margins. It's like, so your commissions are based on how profitable it is to your insurance company. I don't see any difference there. That seems like even worse to me. So you're going to sell the products that make your company the most business, and then they're going to pay you more. And, you know, it's like, she wasn't really saying anything. I think she was trying to the gobbledygook kind of, let me just say something that sounds like something, but it's like, yeah, it's, I even told her, I said, man, that sounds like the worst to me, but okay. Anybody want to disagree with this? On the exam, you can disagree with it. You notice on the exam question, I even say your answer doesn't imply you agree with me. And if you don't want to waste time on the exam answer arguing the other side, then just say it up front. I disagree with this answer, but this is what the professor said, all right? So, but if you want to argue the other side, should you work for a company, should you work in a job that is heavy commissioned? So you have to think through that. Some people I know are really good salespeople and they love this. It was very irritating to me. We had a person come in who was a wealth manager, and he was bragging about the best wealth manager he knew. This guy was making a fortune. And he made the comment, it's like, yeah, he really doesn't understand our products, doesn't understand the stock market, but boy, he knows how to sell. And the guy was saying that to encourage students to become commission-based. I thought that's horrible. He's not successful because of his knowledge and his skill. He's successful because he knows how to do a sales job when people, like, that would be a horrible life to me. I wouldn't want to do that, but some people, like, they love that. Man, I'm a great salesperson. I can sell anything. I can sell ice to people in Alaska. Yeah, I don't like that, but would you want to know this going in, selling for a company? There are some great companies that do have commissioned salespeople. The products are good. They're not horrible products, but I still dislike the commission sales because they're selling more of the product that I don't think is as good versus the product I think they should be selling. So I still think it distorts things, even though the products they're selling. So maybe product A was better for the customer, and they sell product B, but product B is still a good product for this company. They're a good, reputable firm. They're selling good products that aren't mispriced, but they still should have sold product A. They sold product B because of commission. I still think it's a problem. At USAA, I've heard rumors about them trying commissions, but they still don't. They don't have commission sales reps. There are contests inside the company because insurance companies make a lot more money on these type of products than do off of term. And USAA has been 80% term and 20% the other products, and they've been trying to get that 20% higher. And so they give vacations out, whatever they can do to the salespeople to get them to sell these products. But they can't do it. USA just cannot sell these because they're on the phone. And these commission sales agents are sitting in people's living rooms talking to them. It's a huge advantage. So USA, as much as they like to sell these not as good products that are much more profitable, they're just not set up to do that. And it's really, really tough for them. But I was kind of proud at USA that we didn't have commissions. So I hope they don't go that route. How many life insurance companies have a commission? It's a pretty high percentage. It's a pretty effective way to sell your product. You have very, very dedicated sales reps that will push your product pretty hard. So let's be aware of that. You'll probably be hearing from them soon. Any questions on that? That's a pretty big part of this. That is right there. I mean, I mentioned what does the life insurance company have that banks, investors on? That's it. That's a huge, huge, huge advantage. Very incentivized salespeople. All right, here's one you're going to hear more about maybe next class, but oh, this one makes me so mad. What is one place where the life insurance industry does have a huge advantage over other companies? It's the tax code. So life insurers do have huge tax advantages over banks investment. No question. In fact, I would argue without the tax code advantage, this industry would shrink 80%. I mean, it's huge. It's a big part of what they have. So I don't deny that. They do have tax advantages. So you might buy a traditional IRA or Roth IRA. Well, the tax code limits you how much you can put in, maybe $7,500 a year. And that gives you, if you do a traditional IRA, you get a tax deduction up front, but then you pay tax in the future. Do a Roth, you don't get the tax deduction up front, but you never have to pay tax. But you're limited. You only do like $7,500 a year. So it's very, very limited. If you have a 401k plan, you probably can't do anything because that's where your money's held. Well, life insurance, they can do a whole lot more than that $7,500 and get you the tax deferral. You don't get the tax deduction, you're still limited to $7,500, but you can put more money in. It can be tax-free for 20, 30, 40 years. That's a huge advantage. So guess what sales reps do? At the point of sale, guess what they're saying? Tax advantage, tax advantage, tax advantage. Hard, hard, hard sell. This product has huge tax advantages. You can't get these anywhere else. The life insurance industry is quite unique in that if you buy a whole life policy and the person dies, so you invested all these years and then you die, all of that insurance proceeds comes out tax-free. It's a huge, huge, huge advantage. You could have invested in an investment firm $50 a month, or you could have bought a whole life policy $50 a month. At age 70, the investment products worth $500,000. Are the life insurance proceeds $500,000? This one's going to be taxed. This one's tax-free. It's a huge advantage. Well, that's good. So they do have an advantage, significant advantage. And at the sell point of sale, they push that. But when the IRS giveth, what else does it do? Take it away. So how do they take away? These are extremely illiquid products. They're hard to get out of. What if you change your mind and get out? What does the IRS do? They're probably going to give you a penalty tax. If you want to switch to another company, it's a real pain to do it. They're very, very low. So you better know what you're doing in these products, which means after you buy the product, something happens, you've got a serious tax concern. But later, when tax issues arise, what do you think the salesperson says now? Oh, let me help you with that. Yeah, we got tax attorneys here. They can help you. What do they do? Not our problem. Wash your hands. You're responsible. I love what they like to say. They like to say, consult your tax attorney. Which, how many people do you know have a tax attorney? Not a whole lot. I didn't say your CPA, your tax attorney. Not many people have that. So when they sell the product, yeah, taxes, taxes, taxes. When taxes blow up on you, hey, we don't have any, that's your decision. You're responsible for taxes. How many of these products you think they would sell if upfront they said, these have tax advantages, but they're really complicated. So you only want to buy this product if you have a tax attorney working for you. Would they sell as many products, do you think? Well, not complicated company products. So I think this is a travesty. I'm okay with them saying this later as long as upfront they say, yeah, the tax advantages, they're great, but the tax code is quite complicated. This is not the type of product you're going to change your mind 5 years from now. Because you're going to find 10% penalties, you're going to find it's really hard to get your money out. And it's not only the taxes that are a problem, it's also the insurance company itself. They have penalties, they have surrender fees and those type of things. These are hard products to get out of later. I think they have a moral responsibility to say that at the point of sale. And not just everything's all wonderful and beautiful at point of sale. These products advantages come with some pretty huge negatives. But those are advantages. What you'll find is with this one here, the tax advantages are competing with the expenses. So what you'll find with a lot of these products is if your holding periods 3, 4, 5 years, they make no sense. But if your holding periods 20 or 30 years, those tax advantages can offset the expense disadvantage and the products can start making some sense. So there's some products like some of the variable products. If you're going to hold them for 20, 30 years, then yeah, what you lose on the expense side, you'll make up in the tax advantages. But 20, 30 years is a long time. When's the last time you entered into a contract that you were, would you sign up for Netflix if you had to pay the monthly for 30 years? You couldn't get out? Probably not. Well, some of y'all might, but who knows? If Netflix even be around in 30 years. So it's, you're making a commitment. And if you change your mind, be ready for man, some heartaches. I'll give you the story of my mom and we'll talk about that one. I wish Bill Gates would let me take the yellow coloring off, but he won't. Y'all notice that anytime anything goes wrong with a computer, I blame Bill Gates. So he's just my catch-all for all computer problems. He was in town a couple years ago and I got all these texts from students saying, stay away from downtown. They're worried I was going to go to jail or something, but I did not. Jump back up. So complex products. All right, so this next one, students struggle with this one. Actuaries, y'all should be somewhat comfortable with this. This word stochastic. Now, actuaries, y'all take a stochastic class, right? Is that an elective or is it required?
It's an elective under my catalog, but it counts required.
Yeah, I don't know how, to me, it should be required. I've never taken a class like that because I'm not, my brain cells aren't big enough, but it's, I mean, life insurance and property casualty do a lot of stochastic analysis. It's setting up scenarios, some pretty complex, I'm sure AI is getting involved as well. Why do you do stochastics? Why do you do simulation? So you got this math and you're trying to find an optimal solution, but the problem's far too complex. So rather than trying to figure out this massive equation, you instead set up the pieces that you know, and you just run scenarios and you let the scenarios tell you the distribution. So sometimes stochastic analysis is the only solution. These products are so complicated that stochastic analysis, simulation, Monte Carlo, however you want to say it, that's the only way to figure these products out. You've got to run thousands of scenarios. And when they are tested, they perform poorly when run through sophisticated stochastic models. I can't spell sophisticated. Bill Gates can. See, I sometimes compliment him. And there's something known as stochastic dominance. Has anyone heard that term before? So you run 1,000 simulations And the question here is, we're going to compare these complex products to a very simple product. For example, remember they're asset gatherers, so they're talking about this at an investment. Say, hey, this life insurance policy, yeah, it gives you life insurance, whatever, blah, 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 but it's a great investment. They say, okay, great investment. Well, I could just go out and put 40% of my money in the treasury notes, 60% into a Vanguard index fund. How does it perform against that? So you run 1,000 scenarios. Sometimes the complex product wins, but how often does it win? Well, I'm going to show you an article. It wins maybe 4% of the time. So if you do the simple product, you win 96% of the time. If you do the complex product, you win 4% of the time. So did the simple product win 100% of the time? No, but what did it do? It dominated the stochastics. It had stochastic dominance. The simple products have stochastic dominance win overwhelmingly. I don't think I spelled that right. Sorry. I should look before I type. So when we compare the complex products to the very simple products have stochastic dominance. So the example I'm going to show you is it's not on life insurance, on annuities, but equity annuities. When they ran the models there, the annuities won 4% of the time, the simple product won 96% of the time. And when the complex products did better, they only did a little better. So they did win 4% of the time, but even in the 4%, they're only slightly better. Would you recommend someone buy that product? Does that make any sense? Doesn't make it on who's waiting for it. Well, yeah, if you're a sales rep, maybe if you're selling it. It's like I always say, do you recommend people gamble? Would that be a good recommendation? And so my recommendation is, yeah, gambling's good if you're the house. If you're the gambler, I don't think it's all that good of an idea, but if you can count cards or whatever, even that doesn't give you a huge advantage. But yeah, I mean, the life insurance company, this is a gamble. They win overwhelmingly versus their customers. Their customers lose versus simple products. Most people are better off keeping it simple. If you saw that in my blog, is if you don't understand the product, don't buy it. And these are products that are not just difficult to understand for the customer. Let's go back to the complexity. I should have said more on the complexity. Go back up to complexity. These products are beyond the understanding of the customer and of the salesperson. These products are so complicated that the people selling them don't understand. Now, if you read my blog, how do you get around this? So the questions I would always ask, say, okay, this is a complex product. You say it has these tax advantages. You say if the stock market's up, I make money, but the market's down, I don't lose money. That sounds too good to be true. I tell you what, let's make it simple. Take this product over the last 30 years and just show me how that product would have performed versus me just going to Vanguard. And what will the sales rep say? Can't do that. Well, can you go back to the firm and get that information? No, can't do it. I mean, that's a pretty reasonable question, isn't it? You want to compare a Vanguard product to a Fidelity product, however that be. I mean, I could go to the Bloomberg machine and do that in about 3 seconds. It's pretty easy to do. So they say we can't do that. So then you say, well, why can't you do that? What are they going to say? Well, they'll say some gibberish, right? They got to get the sell done, something that makes no sense. Then what do you say? That doesn't make any sense to me. So this is where the confidence comes in, to say, you're not selling me this product until I understand it. And what you just said, you could have said that in Hebrew, and I don't know Hebrew, and I would understand it just as well. So maybe today, maybe what you do is say, hey, say it to my chat GPT, and if they can figure it out, what did this person chat GPT would say, that was gibberish. I said, see, so it's gibberish. So you should never get off of that dime. I still don't understand what you're saying. We had a CEO at USAA. He wasn't real popular, but he did radically change the company in a lot of good ways. That was his style. If he didn't understand it, he was confident enough in his intelligence. It's like, I don't know what you just said. And he used to irritate me because I would present to every member of the council. They all sign off on it. I'd present to him, and he'd go around, do y'all know what Ron just said? I say, we're gonna understand this. I just saw you last week and you understood it then. He'd make it go back and present it all again. And I didn't go, well, I just told them and they said that I didn't say that, you don't burn your bridges. I went back and presented it again, but he was really good at that. Do you understand this? And it was a great technique she tried. He went around the room. It's interesting. They're about all to vote and say yes. And he discovered if he goes around and asks them individually, all this stuff starts coming out. And they say, I know, I didn't understand it. So you've got to do that. If people are selling you stuff, I don't understand it. I still don't understand it. And you can, make a joke at it. Yeah, I'm sorry. I'm one of the dumbest people you've spoken to, but unfortunate for you, I'm not buying this until you can dumb it down to my level. And you just keep on that. And if you don't understand it, you don't buy it. If you do that, you're either going to be there for 10 hours or they're going to give up and leave, but you're not going to buy the product. Why? Because they don't understand it. Why is it that what they're telling you doesn't make sense? Can you tell when someone is saying something they don't know what they're talking about? I've had students do this in presentations. It's like, please don't keep talking. You were just asked the question and your answer should have been, sorry, I don't know the answer to that. Instead, you try to throw out every piece of jargon and that's kind of what they do in these situations. So push them. These are really, really complex products. The sales reps are not trained on the products, they're trained on selling. So they just have catchphrases. And so these are tough products. We'll see. We'll look at some of these products. When we looked at the Echolink products, especially the complexity, I'll show you some of the sentences in these products and you're going to just go, yeah, there's no way a human being is going to understand what that says. It's really complex. All right, so the last part of this, I don't know if we have time. I'm going to take next class. So next class, I'm going to tell you, I think it's in my blog. I'm going to tell you the Danya story. And then we'll finish Article 3 for paper 1. All right, everybody see where we're going next. So read Article 3 for paper 1. I'll tell you the Danya story, bring some tissues of the crying, really sad story. But just to show you what this life insurance industry has done some individuals. All right, I'll stop it there. Make sure I have you for attendance.